Welcome back to the channel, and I just want to cover off another fund that's been talked about a lot in the Discord, and so I thought I'd cover it off today. It's the LNG Global Quality Dividends. And I think there's going to be some irony because I covered the Global X Super Dividend recently, and there is quite a big contrast between the two funds. So I think it's a good time to probably cover both off. So it has a distribution and an accumulated version. So I know there's been a lot of banding back and forth around the tickers in the Discord. And for those of you that are not part of the Discord, I'll put the link in the description. Please come and join us in there. There are a lot of like-minded investors, and you can get a lot of early insights into a lot of the funds that are coming out, a lot of discussion around new funds and existing funds. So it is ISA eligible, it is SIPP eligible, it is UCITS compliant, which is really important. So we're going to take a kind of deep dive into the fund, the targets, the financial health, the dividend consistency, and is it another high yield chasing type fund? So let's start off with the strategy. So it's going for quality over quantity. So the fund aims to provide exposure to companies with higher than average dividend and quality characteristics in developed market countries. So the important thing here is developed market countries. So these are countries like the UK, USA. It's not like countries like Brazil, as an example, or South Africa. So the fund snapshot invests in a basket of stocks aiming to provide equity income with quality screens and responsible exclusions. And we'll talk about the responsible exclusions a little bit later on in the video, so hang around for that bit. The strategy seeks companies distributing income consistently while screening out stocks with fundamentally poor balance sheets, income sheets, and or environmental, social, and governance, ESG as it's typically referred to, characteristics. So unlike standard high yield funds that may fall into value traps, companies with declining stock prices pushing yields up, which is what we saw with the Global X Super Dividend, and that was my fear with that fund. LDGG tracks the FTSE Developed All Cap Dividend Growth with Quality Index. Bit of a mouthful. This methodology filters the global equity universe for quality characteristics. So this could be profitability, cash flow generation, and solvency. It aims to deliver higher income than the broader market with lower volatility. As I said, the UCITS ETF is tax wrapper friendly for UK investors, so you can hold it in an ISA, and it is SIPP eligible. It's crucial to select the correct share class for your specific tax and income strategy. The distribution version pays out a dividend. Primary LSE listings are LDGG, price in GBP, and LDGQ in USD. And then you've got the accumulating version, and the only difference there is it automatically reinvests the dividends. So for me personally, I like to hold the distributions in a tax wrapper because it doesn't incur any tax event when I get the dividends, and I have full control over that. I can then choose to put it back into the fund, or I can choose to take the money and put it into something else. The accumulation versions are good for me personally outside of a tax wrapper, where I can control when the capital gains is realized. So obviously there is a slight difference in terms of the tax treatment here in the UK for those. That's typically how I tend to preference things. If it's when there is an accumulating and distributing version, I tend to focus on it. The other thing to bear in mind is fees. So if you are with a broker, I have my brokerage split between HL and Trading 212, and with HL the fees could be quite high for trading. Typically, whether it's in an ISA or in the taxed version, I do have to take into account the fact that if I'm reintroducing the money back from the distributing version into another fund or back into the same fund, I've got to pay those fees. But to be honest, I don't use a general account with HL for that reason. Okay, so both versions are actively traded across the major European exchanges as well. So it is on the Extra, so the German exchange, the Borsa Italia, and the Swiss exchange as well for our European colleagues. Okay, in terms of some just high-level metrics, the dividend yield kind of target is 3.4%. Now, this is an estimate. It's a very new fund, so just bear that in mind that it hasn't been around for very long. Okay, so its track record is fairly new. Its expense ratio is 0.25%. It has around about 150 holdings. It does distribute monthly, fifth business day. Current AUM is 31.3 million as of 19th of Feb. So it's had fairly good inflows already, considering it's a fairly new fund. And we'll talk about maybe why some of that is as well, and why there's some buzz in the community around it. So if we look at the sector allocation, a key differentiator of quality dividend funds is the underweighting of pure growth. So tech, basically, and overweighting of resilient sectors like financials and industrials. So here we can see the kind of breakdown between tech, financials, healthcare, industrials, consumer staples, consumer discretionary, comms, and energy there. Another important point is the geographic exposure. So while global, the fund maintains a significant allocation to North America due to the sheer volume of the high quality dividend payers in the US market. So this is not uncommon in terms of the fact that obviously you've got fairly good dividend payers in established markets. And we can see North America's at 64%, Western Europe at 18%, Japan 8%, Asia Pacific 6%, and the rest is held in cash or other at 4%. So if we look at this from a quality perspective, the term quality in investing isn't subjective. It's mathematical, defined by specific balance sheet metrics. So LDGG screens specifically for return on equity, so companies that efficiently generate profit for shareholder capital. Low financial leverage compares with manageable debt loads, reducing bankruptcy risk during rate hikes. And earning stability, so consistently earnings growth over time, avoiding cyclical boom and bust stocks. And we can see how this might compare against a broader market like the MSCI world, where there is other things such as volatility that comes into play when you buy an all-world index. When we talk about responsible investing and the ESG profile, this is quite a heavy lean on this particular fund. And this can be a pro for some people that care about ESG and a con for others because it does impact the yield. Okay, so some of the sin stocks, etc., typically have higher yields. So sin stocks might be oil companies, tobacco companies, etc., highly profitable, not well loved. So let's dig into this a little bit more. So what is ESG? ESG stands for environmental, social, and governance. It's a set of standards used to evaluate a company's behavior and ethical impact. It looks at how a company impacts the planet environmentally, how it treats its workers and communities, social, and how it transparently and ethically it runs governance. And so the promoting characteristics, the fund promotes a range of environmental and social characteristics met by tracking the index. Environmental, climate change mitigation by avoiding investments in thermal coal. Social, adherence to UN Global Compact principles, human labor rights, anti-corruption, and avoiding controversial weapons financing. We then look at the FTSE ESG exclusions. Issuers are excluded from the index based on strict criteria determined by FTSE. So that's thermal coal mining revenues greater than 25%, thermal coal power generation greater than equal 25%, controversial weapons manufacturing basically greater than 0% of revenue, non-compliant with UN Global Compact principles. And as I put a note here on sin stocks, unlike strict ethical funds, this ESG framework targets specific areas, coal weapons rights violation. It doesn't automatically blanket ban traditional sin stocks, e.g. alcohol. So this would include companies like Diageo, tobacco, which would include things like British American Tobacco. You've got gambling stocks as well. So unless those specific companies fail the UN Global Compact principles, they're okay for inclusion, which can help the yield a little bit if they're included. If we look at the SFDR and taxonomy notes, principal adversary impacts, so PAI, the fund actively considers specific adverse sustainable indicators. And there are two that have been called out. So PAI 4, exposure to fossil fuel companies, PAI 14, exposure to controversial weapons. So while promoting E and S characteristics, Article 8, the fund does not commit to investing in sustainable investments within the meaning of the SFDR and underlying investments do not currently take into account the EU criteria for environmental sustainable income activities. So a little bit around why some of the holdings will be there and why some holdings may not be there, despite the fact that it's maybe a class as a quality company. Okay, the benchmark. So I thought it'd be useful because a lot of these typically follow some kind of benchmark. We can get a idea of its potential returns. Now, obviously, past performance doesn't drive future performance, but it does give us that kind of compass of direction. So because LDG ETF was launched recently in November 2025, obviously the long-term fund performance is not available yet. However, as I said, we can evaluate the back testing track record of the underlying benchmark, the FTSE Developed All Cap Dividend Growth with Quality Index across short and long-term timeframes. So let's talk about the index itself. The index contains stocks that have a positive dividend growth, a relatively high forward dividend yield, and enhanced quality exposure. The index is reviewed semi-annually, and at each review period, the index excludes companies which have negative or zero return on equity or do not meet specific ESG criteria, which you talked about earlier. Constitutions for the FTSE Developed All Cap Dividend Growth with Quality Index are derived from the broader FTSE Developed All Cap Diverse Index universe. So let's start to look at some returns now. So the 1 month has been 1.2%. The broader market's been 1.5%. 3 months has been 3.5%. Broader market 4%. Year to date, 1.5% to 1.8%. If we look at the 1 year, 12.4% compared to the broader market at 14%. 3 year annual, 9.8%, broader market 8.5%. 5 year annual, 11.2%, and then 10% for the broader market. So it has actually done pretty well historically from the numbers perspective. If we look at the risk return analysis side of things now, positioning kind of LDGG relative to other major asset classes, ideally we want to be in the northwest quadrant, higher return, lower risk. And we can see actually if we were to look at the completely speculative end with crypto at the top right, we've then got the MSCI World sort of sitting, hovering in the middle. LDGG kind of focuses more on the quality side, so it bridges the gap between bonds and the broad market. I think it has a really good place in a portfolio. And after doing the analysis on this, I'm actually tempted by it, I'll be honest. The data is a little bit lacking, but the more I look into what the fund is doing, how it's doing it, I think it would fit quite nicely into my portfolio. There's a lot of a bit anti-bonds at the moment when I did a 40-year back test. So it's put me off them a little bit. I haven't bought the income shares TLTI yet, but yeah, so this fund might actually cover that little gap because I'm looking for a gap that covers things that are not tech focused as well, that gives me exposure to other things. And maybe this is a good example of that. However, saying that, the top holdings are tech based. So we do have Microsoft, Apple, Broadcom in there, but then we do have a mix of other things like financials, JP Morgan, ExxonMobil, Johnson, Home Depot, American Co, AbbVie, and Chevron. Okay, let's move on to the pros and the cons and the risks. So from a pros for the fund, it avoids value traps. So a bit like how I was slightly against buying the super dividend from Global X for my particular fund, it does quality screening, ensuring you aren't buying failing companies just for their temporary high yields. Lower volatility focuses on robust balance sheets, typically provides downside protection during market corrections. Dividend growth, so it's focused on profitable companies that are more likely to grow their dividends over time, combating inflation. And there is some global diversification exposure across North America, Europe, and Asia, which reduces that single country risk. When we look at the cons and the risk, lower absolute yield, so sacrifices a maximum possible current yield for safety. Purely income focused investors might find 3.4% a bit lacking. Growth underperformance will likely underperform the standard global indexes like MSCI during aggressive tech-driven bull markets. However, we've seen it can outperform. Sector concentration, heavy reliance on mature sectors like financials and industries, making it sensitive to economic cycles. And there is still the fee aspect. A TER of 0.25% is reasonable for smart beta, but more expensive than plain vanilla market cap weighted ETFs. So from a verdict perspective, the LNG Global Quality Dividends UCITS ETF LDGG serves a potent core holding for income seekers who fear the volatility of pure yield chasing by focusing on quality. And as I said, that's not subjective. It sacrifices the highest possible immediate yield for capital preservation and dividend growth sustainability. It's best suited for long-term investors seeking a blend of moderate income and capital appreciation. So there you go, guys. Hopefully you found this useful. If you haven't already, please like the video. Don't forget to subscribe if you haven't. Turn on those notifications so you get alerted about future videos. But let me know in the description whether this is a fund that you're interested in buying or you bought into it already, or it's one that you're reviewing, to know people's thoughts on this compared to some of the other funds that we talk about regularly on this channel. Thanks a lot for watching, guys. I will catch you on the next one.